But we are hearing, Ian, that it's gone up to 5%. And I suppose with that result, some may worry, does that show the bank is panicking?
Yeah, that is a very, very significant move indeed. I think the bank's hand, the Monetary Policy Committee's hand, Jane, has obviously been forced by those very disappointing inflation May figures that we got yesterday. I think the bank has decided they had no option, really. If you think about the fact that inflation in May was 8.7%, well, that remains more than 4 times the target rate of 2% that the Monetary Policy Committee is mandated to target. And they feel, obviously, they have had very little choice in the matter. What is really quite interesting there is that there's been a body of the Monetary Policy Committee who were against raising interest rates. I'm looking here, Jane, at the press release that the Bank of England has put out. It was a majority 7-2 vote to raise bank rate by 0.5%. So you don't have to be a genius to know who voted against raising interest rates. That would have been Salvana Tunrano and Swati Dengra, who were the doves on the Monetary Policy Committee. What is really, really interesting is that all the other members of the MPC voted to go by 0.5%. There was a bit of speculation in the market that you might see a 3-way split, that you might see some members voting to go by just 0.25%. So the fact that the vast majority have gone for that half-point rise is very, very interesting. I can read you, Jane, a bit of the commentary that we're getting here from the Bank of England. They are noting here, they say, business surveys continue to suggest underlying quarterly GDP growth of around 0.25%. Household spending has strengthened a little, but it's this question about earnings that I was talking about a moment ago, Jane. That is what's really forced the Bank of England's hand here. The fact I mentioned it just before we got that decision. Average earnings increased by 7.6%. in the 3 months to April. That was above the bank's expectations when it last issued its quarterly inflation report. And the bank goes on to say in this statement here, 3-month growth in this measure of pay has also picked up. Now, the bank's suggesting that earnings growth is going to ease over the course of this year, but it's really the fact that you've got these persistent inflationary pressures. They're talking here in the statement about core inflation. Now, we were talking about this time yesterday. Core inflation is the measure of inflation that strips out volatile elements such as food and drink, alcohol and tobacco, and that actually rose in May from 6.8% to 7.1%, and that was another real indication that inflation is becoming entrenched in the UK economy, and that is addressed squarely here in the Monetary Policy Committee's statement. They're saying that core goods price inflation has been much stronger than projected. It goes on to say here that they expect CPI inflation to fall significantly further during the course of the year. Well, we've heard that from the Bank of England before, and it hasn't really materialised so far to date. The bank reiterating here, CPI inflation is expected to decline later this year. They're talking about food price inflation in particular, which they say they think will fall further in coming months. But here is the key statement, I think, Jane. The MPC's remit is clear that the inflation target applies at all times, reflecting the primacy of price stability in the UK monetary policy framework. The framework recognises that there will be occasions where inflation will depart from the target as a result of shocks and disturbances. Monetary policy will ensure that CPI inflation returns to the 2% target sustainably in the medium term. The MPC recognises, and here's the crucial bit, Jane, that the second round effects in domestic price and wage developments generated by external cost shocks are likely to take longer to unwind than they did to emerge. There has been significant upside news in recent data that indicates more persistence in the inflation process against the background of a tight labour market and continued resilience in demand. And accordingly, the committee voted to raise bank rate by 0.5% to 5%. And the MPC will continue to monitor closely indications of persistent inflationary pressures in the economy as a whole, including the tightness of labour market conditions and the behaviour of wage growth and services price inflation. And I think this is the bit that will alarm a lot of people. If there were to be evidence of more persistent pressures, then further tightening in monetary policy would be required. And that is something that the bank has hinted at. It's certainly what's being priced in by money markets. You recall earlier on this morning, Jane, when we were chatting about this, I mentioned that the market is now pricing in a terminal rate, which in the jargon is the point at which interest rates peak during the current rate tightening cycle. Well, the market is pricing that in now now at close to 6%. So even from here, we have quite a long way to go. Big moment this, the 13th consecutive interest rate rise from the Bank of England since it began raising rates back in December 2010.